Welcome back to Investing Talk Podcast.
Today we're looking at Vsee Health. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We have a classic high-growth, high-risk scenario here. I mean, the bull case really rests on some undeniable operational momentum.
Okay, operational momentum. What are we seeing specifically?
Well, the numbers themselves are pretty stark. Record revenue growth. Q2 2025 revenue hit $3.4 million.
$2.4 million. How does that compare?
That's a massive 98% jump year over year. Almost double.
Wow. Okay. Nearly doubling.
Yeah.
And what about the bigger picture, like trailing revenue?
Yeah. The TTM revenue trailing 12 months is currently sitting at $13.8 million. So, real acceleration.
Right. And is this just sort of broad growth, or is it tied to specific wins?
It's very much contract-driven, especially this rapid expansion they're seeing in teleradiology. That seems to be a key driver.
Teleradiology. Okay.
They integrated their platform across 17 hospitals already out of 25 they planned. And that seems to have built momentum because they immediately secured 3 additional contracts.
Okay, so the platform rollout is actually pulling in more business.
Exactly. And those new contracts alone, they're pushing the estimated annual recurring revenue, the ARR, up towards $3 million.
$3 million ARR just from those few deals. That's significant recurring income.
It is. And the market noticed. Remember that recent surge?
Oh, yeah, October 29th, right. It jumped quite a bit.
Up 18.87% in a day. That was right after the news broke about a partnership with a major healthcare provider. They haven't named them, but clearly the street liked it.
Okay, so nearly doubling revenue, locking in recurring deals, getting market attention. That's huge growth. But the telehealth space is pretty crowded. What's giving them this edge? Is it just execution?
Well, execution is part of it, but there's something else. I'd say the real aha moment, the thing that really sets them apart, is regulatory.
Regulatory. How so?
They achieved the FedRAMP high authority to operate the ATO.
FedRAMP high ATO. Okay, that sounds technical.
Oh.
Why is that such a big deal for a telehealth company?
Think of it like a security clearance for cloud services dealing with government data. FedRAMP is the standard across the U.S. federal government. Getting high authority means they meet the absolute strictest security requirements for handling sensitive, unclassified data.
So this lets them bid on government contracts,
Yeah.
high security ones.
Exactly. It unlocks access to this really lucrative federal government telehealth business. We're talking defense, veterans affairs, potentially. Markets that require that top-tier security level.
Which most smaller telehealth players just can't touch.
Precisely. It's a serious competitive moat, a defensible advantage.
Okay, so that's a major point. It's not just growth. It's growth into a protected market.
Right. And combine that regulatory edge with their tech focus. They aren't just doing, virtual checkups.
They're more specialized.
Yeah, they're focusing on critical care coordination. Think neuro, cardiac, ICU settings, complex stuff. Plus, they're rolling out AI-powered modules, particularly in that teleradiology space we mentioned.
So speeding up diagnosis for critical conditions using AI, that sounds valuable.
It absolutely is. So you've got this picture: explosive growth, sticky contracts, a regulatory moat into government business, and focused tech.
It sounds like a pretty compelling bull case. Almost. Too good to be true. Here's where it gets really interesting, right?
Yeah.
Because despite all that great news,
Here comes the but, and it's a big one. There are 2 major overhangs, serious risks that you absolutely need to be aware of.
let's start with the most immediate, maybe that Nasdaq issue.
Yeah, the Nasdaq delisting threat, that's hanging over everything right now. They got a delisting notice back on August 5th.
Why? What was the issue?
Delayed regulatory filings. Basically, they didn't get their required paperwork into the SEC on time.
Ouch. That's never good. What's the status now?
Well, they've requested a hearing. They're working on getting compliant. They did manage one positive financial cleanup, recently eliminated over $5 million in old legacy debt from their SPAC deal.
Okay, so they're taking steps, but there's a deadline.
Yeah, there is, and it's coming up fast. December 1st, 2025, that's the NASDAQ compliance deadline. They have to be compliant by then, or at least have a credible plan approved by NASDAQ.
December 1st, okay. And if they don't make it?
Losing that NASDAQ listing would be, well, pretty catastrophic for investor confidence. A lot of funds simply can't hold stocks that aren't on major exchanges.
Yeah.
It dramatically shrinks the pool of potential buyers.
Right. It triggers automatic selling for many institutions. A huge risk. What's the second major overhang?
That's the financial health itself. While the revenue is booming, as we said, profitability is, let's just say it's a serious challenge.
Okay, how serious? What are the numbers telling us?
The trailing 12-month net loss is pretty staggering. Negative $63.7 million.
Negative $63 million on $13.8 million in revenue.
Yeah, you do the math. That translates to a massive negative net margin of, wait for it, negative 427.1%.
Minus 427%. How is that even sustainable? They're burning cash at an incredible rate.
They absolutely are. It's the definition of growth at all costs right now. The market's bet, seems to be that this spending secures those big contracts and that FedRAMP status, and eventually the high-margin software model kicks in and flips the script.
Eventually. But that's a big gamble. What about the balance sheet itself? Does it look stressed?
It does. Liabilities currently exceed assets. That gives them a negative price-to-book ratio, around negative 1.85.
So technically negative equity.
Correct. They are relying very heavily on new funding and, crucially, cash flow from those new contracts actually hitting the bank account. That debt cleanup, the $5 million, was positive, but like you said, compared to a $63 million annual loss.
It's a drop in the bucket. Okay. So this really is, as you said, our race against time. Incredible operational success clashing with these huge regulatory and financial deadlines.
Exactly. And that brings us right to the near-term catalysts, the things that are likely to drive volatility in the next 60 days or so.
What should people be watching?
Well, the absolute most immediate event is the Q3 2025 earnings release. That's scheduled for October 15th.
October 15th. Okay, that's like right now for listeners. What's the focus there?
Sustained momentum. Do those contract wins we talked about actually show up in the Q3 revenue figures? Analysts will be looking for confirmation that the growth trajectory is continuing. A miss here could really hurt the stock, regardless of FedRAMP or anything else.
Makes sense.
Yeah.
And then looming large.
The regulatory decider, December 1st, 2025. That Nasdaq compliance deadline. That remains the single biggest driver of uncertainty in the short term. Success removes a huge cloud. Failure is, well, very bad.
Got it. Any other key dates or market mechanics people should have on their radar?
Yeah, a couple more. November 12th is the institutional holdings reporting deadline. That's when we'll get a clearer picture of which big funds, which institutions were buying or selling during this volatile period.
So we see who's betting alongside us, essentially.
Kind of, yeah. It tells you about institutional conviction. And then there's December 20th. That's a major ETF rebalancing event.
Ah, index inclusion or exclusion.
Exactly. If Vsee happens to be in certain healthcare or tech ETFs, the rebalancing by those funds can cause significant buying or selling pressure, totally unrelated to the company's fundamentals that day, just portfolio mechanics.
Okay, good to keep in mind. Now, when a stock is moving like this, surging over 200% like it did in late October, the charts often take over, right?
Yeah.
What's the technical picture look like?
Well, currently, the technical posture is actually bullish.
Bullish, despite the risks.
From a pure charting perspective, yes. The stock is trading above its 50-day moving average and its 200-day moving average.
Okay, classic signs of an uptrend.
Right. It confirms there's been strong buying pressure recently, pushing it above those key trend lines. Momentum indicators are generally supportive too.
So for someone maybe looking at a shorter-term trade or just managing risk, what are the key levels to watch on the chart?
Given that recent volatility, the support zone seems pretty well defined now. Buyers have tended to step in between roughly $0.45 and $1. That's kind of the floor to watch if things pull back.
45 cents to $1 is support. And on the upside, resistance.
The key resistance, and really the threshold for a potential bigger breakout, looks to be in the range of $2.50 to about $3.54.
Okay, 250 to 354.
If the stock can clear that zone, especially on positive news like strong earnings or resolving the Nasdaq issue, then that analyst outlook starts to look a lot more achievable.
And that analyst outlook is pretty optimistic, isn't it?
Very optimistic. The consensus rating is a strong buy, and the average 12-month price target is sitting at $5.
$5. From where it is now, that's
That implies about 371% potential upside. Again, if they execute and if they navigate these risks successfully, it's a big if.
definitely a big if. Now, beyond the hard data, the filings, the charts, there's always market sentiment, rumors.
Yeah.
What's the chatter around VC?
Well, and we absolutely have to stress this is speculation, pure market rumor, but it's definitely influencing trading.
Understood.
Yeah.
Speculation only. What's being whispered?
The loudest buzz is around M&A, mergers and acquisitions.
Ah, the buyout rumors.
Yeah. The talk is that a larger telehealth player, or maybe even a broader digital health company, is sniffing around, exploring either a strategic partnership or maybe even a full acquisition.
Which, even as a rumor, highlights what? The perceived value of their tech and that FedRAMP clearance.
Exactly. It suggests that bigger players see strategic value in what Vsee has built, particularly that access to the government market, that FedRAMP High is a valuable asset.
Any other speculative angles?
There's also some chatter about future growth drivers, things like an imminent launch of new AI tools, specifically for remote imaging diagnostics. Think faster AI-assisted reads for radiology.
Okay, accelerating their core service.
And also some unconfirmed whispers about international expansion, maybe first steps into Europe or the Middle East. Again, pure rumor, but if any of that were to become concrete news.
It would be another significant catalyst.
Okay.
Okay, so if we try to pull back and connect all these pieces, the growth, the risks, the catalysts, the rumors, what's a long-term story here, assuming they survive the next few months?
Well, stepping back, the big picture rationale is still pretty strong. The whole telehealth sector has structural tailwinds, right? Hospitals want to digitize, especially for complex critical care coordination. That's not changing.
Demand is there, basically.
Definitely.
Right.
Vsee serves a specific high-value niche within that trend. So the long-term thesis is that they become a core asset, maybe a target, maybe a survivor, in a sector that's likely to keep consolidating. They solve a problem that large hospital systems have and are willing to spend money on.
If they can just bridge this tricky financial gap.
That's the crux of it. Can they survive the squeeze to capitalize on that long-term opportunity?
Okay, so let's synthesize all this. We've covered the incredible 98% growth, the FedRAMP moat, but also the huge $63 million loss, the negative equity, and that looming December 1st deadline. What does this all boil down to for you, the listener? Is Vsee Health a buy right now?
Based on everything we've looked at, the overall assessment leans bullish. I'd rate it maybe an 8.5 out of 10 in terms of potential. That's really driven by that tangible, contract-backed revenue growth and the sheer number of potential catalysts packed into the next couple of months.
An 8.5. That's quite high given the risk.
It is, but we absolutely have to emphasize the risk profile here. This is a high beta, high reward situation.
Meaning it moves sharply up or down.
Very sharply. It's only suitable for investors with a high tolerance for risk, people who can stomach potentially massive volatility, especially around that Nasdaq compliance issue and the ongoing cash burn. This is absolutely not a widows and orphans stock.
Okay, so risk tolerance is key. How should someone think about timing an entry if they decide to take the plunge?
Well, the timing aspect is interesting. For a more tactical short-term perspective, you could argue an entry before the October 15th earnings is compelling, betting on that continued revenue momentum.
A bet on good news, essentially.
Right. But for a longer-term hold, the viability of that hinges almost entirely on them successfully resolving that Nasdaq compliance issue by December 1st. If they clear that hurdle, the whole valuation argument could shift significantly upwards if they don't.
It changes dramatically downwards. Got it. So maybe a final thought for people to consider.
Yeah, here's something to really think about. We know that FedRAMP High A2 gives them access to a potential multi-billion-dollar government market, a moat very few competitors have. The big question you need to ask yourself is, how much of a discount should the market apply just for that temporary December 1st compliance risk? At what point does taking on that specific time-bound risk become a calculated, worthwhile gamble to potentially own a piece of that unique long-term regulatory advantage?